If we do see a catch up where the gold silver ratio shortens and goes from 100 down to, let's say, 50 or something, that's obviously confirmation. I'm not saying anything wrong, but it does make you scratch your head. So my thought is we are moving toward a reset every day we're closer to it. And the banks are using their one, I'll call it, most important asset, and that's gold. It's free of the bond market. It's free for any currency crisis. It's basically the money of last resort for them. They do not use silver as a monetary asset or platinum palladium. So I think it's bank driven more than it's driven by the retail investor.
A common hue and cry from Team Silverbug is that silver is extremely undervalued relative to its big brother in the world of metallic monetary value. It has to be because its price is so cheap as measured in gold. Technical analysis of silver's momentum indicators reveals stronger underlying buying pressure compared to gold, with relative strength indicators maintaining bullish configurations despite the consolidation period. Historical precedent suggests that when silver begins outperforming gold, the moves tend to be both swift and substantial. Market specialist DavidMorgan warns that the gold-silver ratio staying above 100 is abnormal and concerning. He sees the lack of silver confirmation as a red flag, drawing from Dow Theory concepts. Morgan notes that central banks are driving gold demand as we approach a monetary reset, while retail investors mostly hold rather than buy. He calls gold the money of last resort, and notes platinum and palladium are now overlooked. Russia's invasion of Ukraine in 2022 and the wave of Russian asset freeze by Western countries that followed marked a turning point for the way central banks viewed gold. Central banks' purchases of gold have increased fivefold since the invasion began, and demand from governments is expected to remain high for some time to come. From a technical standpoint, Morgan cautions that the silver market could quickly become strained if there were a significant surge in demand for the real metal. As silver's demand sources are on track to rise, the silver supply is set to mark its fifth year of deficit in 2025. For nearly half a decade, the market's total consumption has outpaced resources, putting significant upward pressure on silver prices. While reflecting on fundamentals, Morgan speculates about several possibilities for silver's growth, including its use in military programs or preparations for a major delivery obligation. Before we dive into David Morgan's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
I think it'll break out to the upside, but it is worrisome. I mean, when we see the gold silver ratio above 100, it's usually what I would call an anomaly, and it lasts usually for just a few days. I mean, now as you outline, Craig, it's been going on for some weeks. And one thing that does concern me, I've written about this, is not only the gold silver ratio, but you might say the yellow white ratio, because you've still got platinum palladium, which classically are money. No one thinks of them as money. I'm not saying they are money, but from a classical definition of money, they are. They're divisible, fungible, at the industrials and transportations, how to confirm the utilities, or all three. One was going off, then you had to question what's going on. You have industry without an increase in transportation. So Giants basically said he wanted a confirmation of silver to gold. And obviously we're not seeing that. Now, if we do see a catch up where the gold silver ratio shortens and goes from 100 down to, let's say, 50 or something, that's obviously confirmation. I'm not saying anything wrong, but it does make you scratch your head. So my thought is we are moving toward a reset every day we're closer to it. And the banks are using their one, I'll call it, most important asset, and that's gold. It's free of the bond market. It's free for any currency crisis. It's basically the money of last resort for them. They do not use silver as a monetary asset or platinum palladium. So I think it's bank driven more than it's driven by the retail investor. You both know, you work with Sprott. I know, I talk to most of the big dealers, both domestic and foreign. And the retail investor is really it's missed a lot of this move in gold. I mean, people that hold it are doing fine, but they're not buying more. So I think it has to do with the psychology of what really coming out in the future. Now, all the people that you and I have educated over, and others, many others, over the last decade or 2 decades or 3 decades, or in my case, 4 decades, they bought it 10 years ago, 8 years ago, 5 years ago, 25 years ago, and they bought hopefully the right amount for them. and they're holding it as an asset that's free of all the other assets. It's got no liabilities, no counterparty risk. Adamant on some of this. I mean, I've heard people I respect, I won't use their name, and here's how it went down to absolutely best of my knowledge. It did start with tariffs. Oh, tariffs have nothing to do with it. Tariffs is what started the ball rolling because these guys did not want to pay at the time. And this has gone back and forth, as fast as Trump changes his underwear. But regardless, when it started, everyone was worried there would be a tariff on bullion. 25% was the number at the time. So that's exactly what started. I don't care what anyone says. That's what started it. Now, once that started, then other factors started coming into it. The other factor was there's a pretty good arbitrage between London and New York.
Yeah.
And because of the arbitrage, that incentivized. So now is it tariffs? No, it's tariffs and arbitrage, or forget the tariffs, it's arbitrage alone, but it went tariffs, arbitrage, combination thereof. Then after that, then this is more conjecture. It got to be, well, we're going to look at the amount of gold in Fort Knox, and we better find some gold and stack it in the shelves real fast so, we can do our shell game. Because if we audit West Point, we'll move the gold over there, and then after that's audited, take the gold out, we'll move it over to Fort Knox, and after that's audited, we'll take it out and take it to the third place. I'm being a bit facetious. Believe me, this has happened. I have proof on this. It's probably happened here. I know for a fact it's happened in Australia because I was involved with John Adams for a long time when we were investigating a facility down there. So that would be my answer. But why exactly, I don't know. I think there was those three reasons of why it moved, but what's the ultimate why is, do we need it for a military program, talking silver more than gold, or do we need it to shore up a bank or a stand for delivery that someone knows is coming in the future? Or I don't know. When you see a silver price, you see a derivative price. You see what the spot price is, and the spot price is pretty much derived from what we call the near month, the month that's trading. And that's done by a bunch of paper contracts, as you well know. And the only problem that could occur is a failure to deliver. Mm-hmm. And the COMEX really can't have that problem because in the contract, if they choose, not you choose, to settle for cash, it can make you settle for cash. And just as a digression, a sidebar, I don't know how many, it's not like hundreds, but, probably less than 20. But over the years, I've gotten, hey, David, I went to my broker. I had these, 2 contracts. I wanted delivery. And then my broker made me settle for, or the exchange made me settle for cash. So how often has that taken place? I don't know. And it's usually smaller guys. I don't know if they do it, bank to bank or whatever, but that's something to consider. So that mitigates having to put physical on the line, right? And so that mitigates really how much if there is a mismatch, obviously with one contract not delivered that wanted to be, that's a mismatch. Is it 0.01% of the total of that delivery month or that non-delivery month? I don't know. But it does suggest that there's not a complete market in the amount of demand physically that's needed. The other part, and in the same digression, is all of what you and I would call manipulation, but if we had to go into court of law, we'd have to call it spoofing. But let's say illegal activity. There was one where it was Morgan Stanley, and they were having these silver contracts or over-the-counter contracts. People were buying silver, storing it, and getting charged. Well, it actually turned out that there was no vault whatsoever. They were getting charged storage fees, and they didn't buy the silver either. They just had like a paper contract against it.
Bag of rocks.
But this is what rubs me raw, and this isn't a one-off example. It's again and again and again. So the court settles. So what are they settling? Fiat. Right. Now let's think about this. If the court did it by the way I think is fair, you would have to go get that silver and make all those people whole that bought the silver, because that's what they bought. If they wanted fiat, they'd keep the money in the damn bank. But they didn't. They bought silver. So why shouldn't it settle in silver? So remember, I know you know this, that when JP Morgan, that last big fine I remember was 920 billion. Remember that?
980, yeah.
Oh, that's a lot of loot for me anyway. What if they had to go in the market and buy the silver? What would that do to the price of silver? But you play in the silver world and it's like a duality. You say silver, you speak silver, you contract silver, but it's a fiat game for the most part.
Yeah.
Because only about 1% of the contracts ever actually turn into physical metal.
Yeah.
And the problem that could happen is non-delivery, as I said a moment ago. But so far, to be fair, most of the deliveries that are required, and that first tranche, if I remember right, was right around 22 million ounces, I think, 24, somewhere in there. And the last set of bars came in brand new,
All
past
fresh.
delivery due.
Still warm.
And I thought, hey, we're at the edge,
Right.
and we probably were at that exact point in time. But a couple years later or so, he made another tranche, which was slightly more. I think it was like 24, and I mean they had it to him almost the next day. So there is an ebb and flow in all markets,
Yeah.
the wheat market
Yeah.
or whatever. But I really was kind of thinking, okay, we're in a place now where they cannot really meet any substantial demand.
In the interview, DavidMorgan states that the silver market's biggest risk is a failure to deliver, particularly between banks or on the COMEX. He argues that futures markets are abused by limitless shorting, which artificially drives prices down. Morgan notes a recent surge in silver miner stocks, which may signal a shift. He urges investors to buy physical silver first, then selectively look at undervalued miners with real leverage to silver prices. On May 22, 2020, silver traded at $17.21 per ounce. As of May 23, 2025, it's at $33.54, a 94.9% increase. Over the same 5-year stretch, the S&P 500 also nearly doubled, gaining around 94%. However, what makes silver stand out is that it achieves stock market-like returns, without being part of the stock market. Silver is often dismissed as a boring or defensive investment, something you buy to preserve wealth rather than grow it. But the past 5 years tell a different story. Silver not only provided a safe haven during periods of global uncertainty, but it also delivered compelling returns that rivaled those of equities. Let's get back to the interview.
Most of the time, the shares will lead the metal.
Right.
I learned that from Jim Dines, among others.
Right.
And so you would see these stocks. Well, why is silver stocks moving? Silver is just sitting at 33, 100-to-1 ratio. So, excuse me, it could be that. I actually hope it is that. But you could flip the coin around, look the other side, and say, well, silver is, it's at 33, which is higher than it's been in, recent past.
Year. Yeah.
And therefore, silver stocks are starting to catch up to that price. So you could make that argument. I mean, the best way to think of it is what is the value? You always want to look at value. I don't like to look at price, and value is, how much oil does an ounce of gold buy? How many, rental properties does 10 ounces of gold buy? How much wheat does, a kilo of silver buy? That type of thing. So you look at the same thing in the price or the value of an ounce of silver versus shares in a premium silver producer. And if you want to catch people that bought silver at, $10 or lower, that's who you want to buy these miners, because that's what they're pricing their silver at, vis-a-vis the share price. And so that's where the real value is. Now, I won't go back on my edict that if you want to get in this space, you got to buy the physical first. And I'm not a bullion dealer, but I really believe that. You want a risk-free asset, or as risk-free as you can get, that has no counterparty risk, that's private, portable, divisible, all the things of real money. So that's where you start. But I wouldn't start large on that space. I'd get just enough for a couple months' expenses. If I had anything left to invest, nothing could hurt them more than a failure to deliver, especially if it's one of their insiders.
Right.
If it's a bank-to-bank failure to deliver, or
Correct.
a COMEX. I mean, industry doesn't buy off the COMEX unless they're really short, need it real quickly.
Mm-hmm.
I mean, most of those contracts are with refiners directly. Why would they ship it from London to New York to Philadelphia where they're making silver wire? No, they're going to go to the refiner. They're going to ship it to the industry user. And that's the way that works. And I mean, so there's a lot of contracts that are not anything to do with the futures markets. And usually they're based on a weighted average or whatever. In other words, you know, I want to lock in silver. I mean, someone will lock it in at a certain price. That happens. But usually it's, you know, 3 months, you know, the average price over the 3 months plus 2% or whatever. But that's an example. It's not exact, but there could be one exactly like that. Anyway, I'm a little drifting off, but the point is there's such a show around the price setting mechanism, as Ted Butler taught us for years. But when you get to the actual silver flows of where the physical moves from and to, it's opaque. It's from refiner to industrial users. It's only the guys that buy it for investment purposes that take it off the COMEX and fill up the SLV or the PSLV, or, you know, Buffett buys it off the COMEX or whatever. But most of the silver coming off the COMEX isn't bought for industrial purposes. It's bought for investment purposes. And the whole investment thing is a scam based on a paper derivative of oats or wheat or corn or T-bills.
Like anything else.
All a fucking paper derivative. I don't know if I can say that word. Sorry. I usually don't. But, you know, you got me triggered because you and I agree on a lot of things. Not everything. I don't agree with everybody on anything. But the purpose of these markets was to be able to hedge for the producer, which I think is noble. I think it should exist. But it's been abused for so long that it no longer serves its useful purpose. If Trump really wants to do something, you get, you know, somebody in the CFTC to right the wrong, you know, and start this as you can only short what you produce within a year, you know, or within 6 months or something that's fair. But if you could short infinity, the price is going to zero of anything, not just silver. If you short, you know, wheat to infinity, there's 10 planets of wheat waiting to dock for us.
The current precious metals consolidation phase exhibits all the hallmarks of a temporary pause rather than a reversal, characterized by decreasing volatility, sustained support levels, and healthy technical indicators that suggest internal strength despite sideways price action. If silver can deliver returns with real-world utility and no counterparty risk, is now the moment to rethink silver, not just as a hedge but as a core growth asset. Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.